Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. A strong move higher as the market punched up and through what I described last week as a weird area of congestion. It was made up from the 2010 to 2014 irregular head and shoulders top neckline, currently at 1615, and the March to June 2021 bearish bump and run reversal trendline extension, currently at 1637. This was something I warned about for 2 weeks. Now, the follow-on higher yesterday went up through and closed over the 2021 high at 1667. Today has moved up again to test the unusual combination of the projected 50% Fibonacci line at 1757 and the September 2012 high at 1759. Okay, that's where we currently are. What could be next? Well, last week I asked the question, and I quote, "Overall, there is the beginnings of a big question that may soon be posed. Is the action from the 2020 high in May at 1667 one of the following? And if it is, which one would it be?" Okay, there are right now 3 possibilities: a rounded bottom, a large cup with handle pattern, or a scallop pattern. This may well be the most interesting thing to find out in the coming weeks, end of quote. Well, the answer seems to be yes to all 3 of them. The action since May 2021 has elements of all 3. Let's now go through each of them. Firstly, the rounded bottom. That has a primary target on the top side in the 1983 area, which is off the top of my daily chart. Next, the large cup with handle pattern. That has a primary target in the 1910 area, once again off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern. This has a primary target in the 1836 area, again off the top of my daily chart, and interestingly, the one I have the least confidence in, even if it is the next nearest. These are all, well, way out there, and plenty of things can happen that may show the recent moves higher have been an explosive venting before a return lower once again. However, I would like to remind you of something I said in my annual review of soybeans looking at longer term charts, made at the start of this year. In this, I quote, "One other idea I would like to, let's say, provisionally float by you. It is way early on this, but it should be worth considering. Is to look at the whole of the 2020 action to date as a possible bullish halfway hesitation. In which case, we might, I say might, with due deference here, we might have a possible target X topside in the 2025 area." I'll just repeat that, in the 2025 area. This is way up off the top of my long-term chart, and it might sound ridiculous now. Indeed, it does sound ridiculous, but it is what I see, and I'd rather say it and maybe look ludicrous and even laughable now than to be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month and likely a multi-year potential target X. So there ought to be plenty of time, plus it will depend on what the market does, when and if it meets the 2021 high at 1667 and the 2012 high at 1789. That's the end of the quote. This is where we are now, and I look forward to seeing what the coming week may bring. Chicago soybean meal. The key feature here for many, many weeks, and one that has been in effect since late November 2021, is the October to November 2021 bullish Andrews pitchfork. The upper time, currently 486.5, had and has capped the market throughout, and somewhat spectacularly just today. Then we have the middle time, currently at 460.90, acting as both support and resistance. Today is support. And then there is the lower time, currently 435.30, acting as support, but getting broken during late January. So why did I still keep this broken Andrews pitchfork on my daily chart after its evident breaking? Well, when the lower time was broken, we had, just below the time, the 50% Fibonacci line for the whole of 2021, running at 390.40 at the time. And it was this that stopped the full exploitation of the break lower, and indeed turned the market back up and back into this now broken but still effective bullish Andrews pitchfork. The move higher 4 weeks ago also allowed me the opportunity to draw a fresh new bullish Andrews pitchfork with the late November 2021 to late January 2022 action, which is at a slightly steeper angle of attack. we have an untested upper time currently at 503.20, an interesting middle time currently at 468.19, and an untested lower time currently 473.70. All are still valid. Now, 3 final points. I've had the target X in the 475 area marked for a few weeks now. This target is derived from looking at the action since late November last year as a bullish halfway hesitation. It is not a perfect target, however, this market has had some pedigree in this, as it formed a similar if smaller pattern between mid-October and late December last year. 2 weeks ago, the high was 474.90, and I called that target X had been reached. Today the market punched up right through it, but has seemingly backed off to look like a very large, indecisive, doji cross, spinning top maps. And it's with a long tail and even longer tongue. The second point is to acknowledge the work the Golden Cross made 2 Fridays ago. It has had in raising prices. I know it's a lagging indicator, but the rising medium moving average, currently 378.20, 30, making a golden cross over the slower long moving average, currently 369.80, I'm sure had an influence in recent events. Finally, and thirdly, it is to look at the late January to date action as a possible bullish halfway hesitation. Yes, another bullish halfway hesitation. I know, but if it ain't broke, don't fix it. And the recent spate of bullish halfway hesitations have certainly not been broken. Anyway, this has a provisional target X1 in the 520 area, just off the top of my daily chart. Chicago soybean oil. The recent major feature here has been, until today at least, the mid-December to date bull channels. The original and narrow of the two, currently 70.53 to 71.88, worked well until early January when the market expanded to a larger bull channel. It reasserted itself between mid-January until 3 weeks ago when the market once again expanded to the larger bull channel. Then, over the last 3 days, especially today, it once more reasserted itself as a base of action for a move up and out of both the bull channels. Nevertheless, I will keep the original broken lower bull channel line on the daily chart because of the market. As the market utilized it 3 times already, it would seem reasonable to hold it near just in case. The newer, wider bull channel still utilizes the now broken upper bull channel line, currently at 70.53, but it has a wider and lower bull channel line, currently at 65.78. This lower bull channel line was verified as recently as 3 weeks ago. Now, there are no other major patterns operational when I read this last week, but a pattern did develop during this past week and reached fruition today. It is a mid-January to date bullish halfway hesitation, and the target was where the 2008 all-time high stood, at about 72.65. This has now left me with 2 options, on looking ahead and higher, at potential resistance points, as today the market has made a new all-time high. For many weeks I had chosen not to draw bullish Andrews and shift pitchforks for the action since December last year, and most recently since mid-January this year. Now, I chose not to do so as these would be very, very narrow pitchforks and likely of limited use, perhaps only good for timing and with nothing really better to offer than what the 2 current bull channels could offer. Well, the bull channels are no longer working, and I've truncated them to the end of next week. And I've also drawn a fresh mid-January to early February, quite active, quite acute, bullish Andrews pitchfork. This seems to be appropriate, as the middle time, currently at 71.08, managed to capture the action over the last 3 days, and the upper time, currently 74.37, managed just about to capture today's high. For the moment, this will be the indicator for the way ahead. There's one final point. I have also drawn a projected Fibonacci line, or projected Fibonacci lines, for the mid-January to early February action. The key levels are the 50% Fibonacci, projected Fibonacci line at 71.42. This is now below the market. And then there's the 100% projected Fibonacci line overhead at 76.04. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.